All right, we are live. Welcome to our Friday night wealth creation course, Finance Friday, as we like to call it. Thank you guys for tuning in. If you've not seen this before, if you don't know who I am, shame on you, shame on me. My name is Jerry. I'm the owner, founder, CEO of Wealth DynamX. And every Friday we do this course. We call it Finance Friday. Okay, and this week's topic, we're going to go over investing. Now, before we dive into this, I kind of want to dive into the reason why I'm covering this week. We've talked about investing before. And it's one of those areas that you really can dive into over and over and over. There's so much depth there. There's so much information there. And so I want to go into with investing, what is it that I've been doing, right? Because I'm 29 years old. I built up a pretty substantial amount of passive income. I'll be able to achieve financial independence for myself and my family in about 6 months. And I've done it from investing, right? But I was having a conversation with someone earlier this week, and he was telling me, man, no matter how much I learn, no matter how much I study, no matter how much I see on the topic of investing, for some reason, I still don't feel comfortable in pulling the trigger on a deal, right? He's looked at deals. He told me, Jerry, I've had people present investments to me. I've gone out and looked at properties. I've looked at land. And for some reason, it just doesn't feel right. And I can't figure out why. And so I was explaining to him some of the stuff I'm going to cover tonight. But the main thing that I want to go over is, to start things out, the purpose of investing, right? You have to understand your purpose. And so we're going to talk about that. We're going to talk about, how to identify the right investments, how to do your due diligence on not just the investment, but also yourself as the investor, right? And then we're going to talk also about, how do you actually fund a deal when you're ready to pull the trigger? What does that look like? What are the steps? I've done this over and over with myself, with clients. So I'm going to share that with you all tonight. Now, before we dive into the meat and potatoes of our course, if you're on Facebook, I want to ask you a favor. Share the stream, okay? If you're watching and this is something that is helpful to you, it's something that is of benefit to you, you learned it, you've been here before, share the stream, get it out there. This is not something we put ad dollars behind. This is something that we really are living out our company mission, which is, our job is to help create financially educated and solvent families who achieve greater financial freedom in life and then share the truth about money with others. And so we're all able to take that final part of that statement, sharing the truth about money with others, by just simply hitting that share button. So smash that like, smash the share button. And then finally, I'm going to dive into what we cover every week. If I go over anything tonight that doesn't make sense to you, okay, I want you to stop and ask questions, right? So I'm going to go over some different things. So if there's words, topics, phrases that don't totally make sense, meaning you don't have pure clarity, 100% conceptual understanding of what I'm saying, then I want you to stop and ask questions about it, right? The only reason why anyone gives up on something, they quit studying it, they tune out, they go stale on a subject, is simply because they don't understand the words being used. And unfortunately with finances, that's prevalent. It's actually one of the strategies used against us by banks and Wall Street, right? So that's the first thing. Second thing, stay positive, be a contributor, be a producer, not a consumer. And then thirdly, we will go live. So if you have questions, if you want to go over different investing topics, we'll go live at the very end. As usual, we'll cover a live Q&A. Now, without further ado, we are going to dive into our topic, okay? Now, again, this is the word invest. Okay, invest. Now, what does invest actually mean? I was a financial advisor for literally years before I actually understood what investing meant. Okay, I thought investing was a product. I thought when I invest, I'm putting money into a stock or a bond or a mutual fund or real estate or an annuity, and that's what investing is. Okay, I couldn't have been further from the truth, guys. And I was a licensed financial advisor, and I didn't know what this word meant. Okay, my job and my profession was to share this with people and get them to do it, with the various stocks, bonds, mutual funds, things that I offer. Okay. So my thought is, if as a licensed financial advisor, I didn't know what investing was, that means that the average person doesn't. Right? That means that the average person watching this stream probably also doesn't know what investing means. And that's not anything that's any fault of your own. Sure, we can all be studying and learning about money, but how many times was that ever talked about in school? Right? How many times was that ever the topic of any sort of conversation you had with a teacher, with a family member, with a parent, with a mentor growing up in school? It usually is never talked about. Right? We go through high school, we go through college, we go through our adult lives, and we never actually understand this thing called investing. Now, investing, when I first heard of it, I remember hearing about a family friend, And he had like a niece or a daughter or somebody like that that bought stocks, and the stocks, went up in value and they got wealthy. And I thought that that's what investing must have meant. This guy that was telling me this story at the time, he was in his 60s or 70s. He had rental properties. He was pretty well off. And so I was sitting there, probably 9, 10 years old, hearing this story. And I'm like, man, so there's this thing where you can just go on the internet and you can pick the right area. And if you put money in that area, it's kind of like a dartboard. You can get rich and never have to work again. Man, what a concept. Okay. Now I was 10 and that was my understanding of investing, right? Not to be mean to you guys or anyone watching, but think about in your own lives and in the lives of those you observe, how many people actually still operate that way? Okay, all we have to do is we have to just look at Dogecoin, right? And GameStop and some of the nonsense we saw happening in the last 12 months. That's literally what people were doing, and they were calling that investing, right? Just throw a dart at the board and hope that you pick the right one and then it goes up. Okay, that's not investing. So when I became, more in tune with financial education in my life, I started looking up definitions of words. Okay, this is so important. So when I looked up the root etymology of investing, there was 2 definitions. There's the actual definition, and my favorite definition is from Warren Buffett, right? And so Warren Buffett talks about investing as the act of putting out capital to get a return of that capital at a greater rate than what you put out, right? That's simple. Putting out money, putting out capital, putting out assets with the hope of getting a greater return of that capital or that asset than what you put out. And that's return on investment. That's the purpose of investing, is to get a return. Right. So that was the first thing. And then I looked at what's called the etymology, the derivation of where the word originated from. And if you followed me for any amount of time, you've been hearing me preach this message for the last 5-6 years. Investing at its root means to clothe your capital. And this stuck with me. I'm simple. I went to high school, didn't go to college. Wasn't a straight A student. I was a C student. I was actually a straight A student until 10th grade. Then I realized they're just going to keep giving me more tests if I kept getting A's. So I decided to stop. And so this stuck with me. Again, I like simplicity, to clothe your capital, right? And so I related this, and you've heard me say this before, I related this to clothing myself. When I clothe myself, and I'm going to show you guys the illustration here, there are a couple things that I look for. First thing is I don't wear things I don't like. Okay, I'm an Alaska boy. I'm a country boy. I don't like wearing, certain things. I don't understand them. They don't make sense to me. That's the second thing, right? So I've got to like an investment, and then I've got to understand the investment. Just like if I was picking out a suit, I've got to pick out the one I like. I'm not going to wear something I don't like, and I'm not going to wear something I don't understand, right? I think about when I go shopping sometimes with Lexi, there are things I don't understand, right? We're looking and I'm like, how could people have this many pairs of shoes? Or what's the purpose of wearing that shirt over that shirt, right? And so there's certain things that don't make sense to me as a person with clothing. And if I'm clothing my capital, I need to make sure that I understand it, that I like it, that it makes sense. Next is that it actually fits me, right? Just like with clothing, I wouldn't wear a shirt that doesn't fit. I wouldn't wear pants that don't fit. They're too big, they're too little, they don't fit me. And investing, that relates to me as an investor. What's my personality? Some of that's going to be what I like and what I understand. Some of that's going to be what are my risk tolerances? What are my goals? What am I going to be using them for? Which leads into this. What are my goals and purposes as an investor, right? What are my goals and purposes as an investor? And a lot of us don't think this part through. Okay, especially today, we see, people investing and they think the goal or purpose is to literally pick the right stock or pick the right crypto token and strike it rich and never have to work again. That's not a purpose. Okay, and so this is the first thing we've got to look at. Now, part of this goes into, I only like and understand so much based on my own ability to analyze and understand what's out there. And I'm going to tell you guys a little bit of a story here. I was actually at a conference this past week. It was an invitation-only event in Dallas, Texas, oil and gas investing, okay? So we're in this room, very small group, probably maybe 12 to 18 people. And we're talking about, CFOs, CEOs, COOs, family offices, CPAs, advisors, top 1%ers. And these are the people that are in this room. This is not something you can pay to go to. You've got to get invited to something like this. And so we're sitting in this room talking about investments. And it struck me that the people in the room understood what was being shared with them. And they understand how valuable it was, how useful it was, how profound it was, 100% because of their financial literacy level. Okay. And I realized that the average person, even if I invited them to that event, wouldn't be able to get anything out of it, because the concepts being used, the vocabulary being used, the deal structure being shared, all of this is new stuff. And unless I'm learning about money every single day, unless I'm studying investing every single day, it's going to go right over my head. Okay. I'm going to start getting sleepy and bored and zoning out. There were times where even I started to catch myself looking at my phone. I'm like, man, what did this guy say that I didn't get just now? Right. And I study money like crazy. It's the main thing that I do is studying finances. And so one of the things that we have to look at is this and this are going to be subject to my knowledge, right? Like, of course, I've got to like the investment. I've got to understand the investment. But if it's like so outside my universe that I can't even scratch the surface of what it means, I'm automatically not going to like it, or I'm not going to understand it, or worse yet, it's going to get presented to me and I'm going to decline it because I don't even see that it's there, because it's that far beyond my own financial literacy level, right? So part of this investing thing is like the old, like if you look back at like, the olden days where people wore loincloths. So like you show them pants and a shirt, they don't understand that. Like they're running around butt ass naked, not because they don't like wearing a pants and shirt, not because they don't understand wearing a pants and shirt. They don't even know what clothing is. They've never seen it. They've never learned about it. They have no experience with it. And so you can show them, this is going to keep you warm. It's going to keep you dry. It's going to keep you protected. They're not going to be able to see any of that stuff, even though they would like being warm and dry and protected, even though they could understand the benefit of being warm, dry, and protected. They can't even understand the first thing about what they're being presented. Right. So that responsibility falls on us as the investor. And this is something I share with my clients, is the number one risk of investing. It's not the asset. It's not the market. It's not anything outside of myself. The number one risk of investing is the investor. The investor is the number one risk. Okay, I learned this the hard way because I was taught to think that there's risk tolerance assessments and that there's all these models and systems that I can follow with investing. And that if I were to follow these, I would be a safe investor because I have all of these different models and systems I can use. Well, if I don't know about the investment, if I don't like the investment, if I don't understand the investment, if it doesn't fit my goals and purposes, if it doesn't fit me as an investor, then I contain the most amount of risk. I can give the most vanilla deal that's proven itself, time and time again, 40 years on end, paid out every single month. And I can give that to a brand new investor. If they don't like it, understand it, it doesn't fit them, it doesn't fit their goals and purposes, then that investment, even though it's been safe, is somehow going to unravel. Not because of the deal, it's because the investor doesn't understand it, right? So this is the first thing to look at, is what is the definition of investing? Clothe your capital. Those are the 4 points of clothing my capital, right? And then I have to understand that I contain the greatest amount of risk based on my own knowledge of investing, my own level of financial literacy. I was telling a client today, and actually I wrote a policy on this for my company about accredited investing, right? Accredited investor, someone that achieves $1 million net worth. Once they hit that threshold, this whole world of investment opportunity opens up to them. It literally is illegal for a non-accredited investor to be solicited to about these types of investments. They're not allowed to know about it. They're not allowed to be advertised to about it. None of the specifics can be shared. I've talked about before that if someone like me shares that, there's actually fines, penalties, and jail time that go along with it, right? And so what we have happen sometimes is I'll have clients that are, clients and prospects that are so eager to become an accredited investor. They're like, man, I just bought a ton of Bitcoin and it went up in value and all of a sudden I'm a millionaire. I think I'm accredited. Can you show me these deals you've been talking about? Right. Well, here's the problem. This person doesn't know jack about anything when it comes to investing. All they did was they threw a dart at the board and got lucky. Right. And so if I take that individual who is technically accredited and I say, okay, we're going to now plug you into all of these deals, right? And we're talking about oil and gas deals and Forex deals and life settlements and all of this interesting stuff that they've never done before. Sure, the returns are great. Sure, the opportunities are there. But this person is actually putting themselves in a position to fail. Okay, because they've never done a deal before. They're not sophisticated. They're not even qualified, right? And so we're taking someone that has the experience level of somebody that's maybe barely just getting through solvency or barely just getting out of the financial traps. And we're now throwing them in the ringer with, multimillionaires and family offices who are definitely there to take their lunch and eat it. Right. And these guys are now thinking that they're going to be able to play with the big boys. Okay. And so this is why we have to understand that risk exists. There's these old adages about if you're sitting at the table and you don't know who the idiot is, it's you, right? This is very true when it comes to accredited investing. And so I wrote a policy for my team to implement with our clients of, hey, no matter what someone's net worth is, if they haven't done all of the blueprint phases, okay, I have this book called Blueprint to Financial Freedom, and we line out, these are the phases we got to follow to invest. Okay, step by step by step. It doesn't matter if you're a multimillionaire. We're going to go from phase 0 all the way up to phase 6, which is financial independence. Okay, and someone can come to me and say, hey, I've already got $1 million net worth. I've already, owned real estate before, but we're still going to go back and we're going to handle all of the underlying risk that this investor has because they may be financially illiterate, or they may have consumer debt, or they may be, not properly protected, or they may have tax liabilities that they're not aware of. They may have, no estate plan in place, right? How many times do we hear about that? The millionaire celebrity that has all this money, they pass away and then they have no estate plan. And then the government decides what happens to their wealth. That story happens all too often, right? And so that's how we handle the underlying risk that an investor has. By going through these blueprint steps and phases, it actually exterminates the level of risk so that when the time comes and someone says, hey, Jerry, I'm accredited, we actually can say, yeah, you are. And by saying I'm accredited, you're also saying, and the next step in my finances is financial independence. I can't honestly say for somebody that just hits $1 million net worth and they don't have any of the underlying blueprint stuff done, that their next step is financial independence. I can point out people that have, millions of dollars and their next step is still financial literacy, right? We were in this event and one of the executives there, he's talking about his family office and he's saying, I have a client that has a $600 million net worth and they still need help with their tax strategies, right? They still need help with finding their investments. They still need help with basic stuff that some of my clients honestly would be able to tell them the answers to, right? I have clients that have 250, $500,000, $1 million net worth, and they probably know more than this $600 million guy does. And Lexi asked me, she was blown away. She's like, how does somebody at that level still suffer from financial illiteracy? Okay, how does somebody that has a $600 million net worth still not understand taxes? Okay, they still don't understand where to put their money. They still need help with their investments. Okay, any of my clients, if you guys hit 600 million, fire me. You don't need me at that point. Like, you better know everything because you got to 600 million. And so what happens is people miss these basic definitions. What is the definition of investing? Okay, what is the purpose of investing? What is the thing that I'm going for? Do I like my investments? Do I understand them? Do they fit me? Do they fit my goals and purposes? These things get overlooked. And so someone builds this giant asset base, giant company, giant investment portfolio, and they don't know what the hell they're doing. Right? They were telling us that what happens is, you guys have all heard of hedge funds, right? I'm going to give you a perfect illustration. Okay. So you have a hedge fund. Hedge funds are typically reserved for something called a qualified purchaser. And so, a large company will go to a hedge fund. This might be, a Fortune 500 company, and they have something called a CIO, a chief investment officer. And the CIO's job is to invest the assets of the company, right? And so a CIO, their whole job is, did I pick the right investments, right? Did they perform well? And based on that, does the stock share price safe? Is it going up? Is it in a normal increasing condition? And so if a CIO makes a bad investment that results in loss, their job's on the line, because their only job is to pick the right investments. And so what happens is, a lot of CIOs, they will go to brand name hedge funds, right? They'll go to the brand names and they don't understand investing. They just know that that's their job. They went to college. They have probably a master's degree or a doctorate in, economics and something relating to investing. But when it comes to investing, they don't actually know how to put their deals together. They will go find a brand name hedge fund. Okay. Because if you go to the brand name, it's the safe bet. So they say, hey, you go to the brand name. If they lose money, you just say it's part of your asset allocation model. We went to, 5 to 10 or 15 different brand name hedge funds. We invested a diversified portfolio with them. We can't help it if they didn't perform. We picked the best names we could, right? Well, what they don't know is these guys work on a fee structure of what's called a 2 and 20, meaning they charge a 2% annual management fee, and then they charge a 20% fee on any profit. Okay. And so they charge a 2 and 20. Now, these hedge funds, they also don't know what the hell they're doing. They're just really good at advertising and positioning. And so they will go to another hedge fund. And so they'll go invest in this hedge fund. And these guys are investing here, and these guys are investing here. These guys also charge a 2 and 20 structure, right? Now, this hedge fund, they also don't invest the money. They'll go to a private equity firm. So they'll go to private equity, and the private equity is the one actually picking the deals. These guys will also charge a 2 and 20 structure. Now, the private equity, they will then invest and they will work with operators, actual, whether it be real estate or oil and gas, actual companies in the business of that industry or that sector. Okay. These guys have their own fees. They're probably not charging 2 and 20, but they are charging their own operating fees, right? So what we have here is these guys up here, the CIO, the Fortune 100 company, the Fortune 500 company, by the time the money gets back to them, they've made little to nothing. And the reason why is they've paid 60% in profit sharing fees, right? And they've paid 6% in annual management fees, plus they've paid the underlying operating fees. And so by the time they get their money back, there's almost nothing left. Okay, guys, I'm pointing this out because this is at the highest level of investing. These are Fortune 100, Fortune 500 companies that fall into this trap because they can't answer the questions that I'm sharing with you tonight. They can't tell you what they like, what they understand, what fits them, what fits their goals and purposes. They can't tell you the etymology of what investing means. They can't tell you what the number one risk is in an investment. Okay, instead they cling to what's called modern portfolio theory. This is one of the biggest myths of investing. Modern portfolio theory, MPT. Okay, MPT states that we diversify, right? It says that we can't predict risk, we can't predict markets, and so what we do is we just get a portfolio and we put it in different, different areas of the world. We put it in different market sectors, different capitalizations, different companies, and we get this pie chart that looks like this, and we have all these different sections broken down. And since we can't predict any of them, we just have percentages in each of them. And hopefully the weighted percentage is positive rather than negative. Okay, that's this idea of modern portfolio theory. Okay, Wall Street came up with this because they say, hey, if you have 30 different funds in your 401k, you need to hire a professional because there's no way in hell you understand if it fits your goals, understand if it fits your goals and purposes and yourself as an investor on 30 different portfolios inside your 401k. So you have to hire a professional because you don't understand what's in there. You don't understand the companies they're investing in. You don't understand the fee structure. You don't understand the vocabulary inside of the prospectuses. And so you better just pay these fees, whether it be a 2 and 20 structure or whether it be, a front end load and an annual management fee, or whether it be fee-based financial planning and investment management. Okay. This modern portfolio theory was created to confuse the topic of investing so that you have to go hire Wall Street and you have to go hire the banks. Right? And this is happening at the very highest levels of investing. So how do we get out of this? How do we mitigate this? Because the guy I talked to today, he said, man, I keep seeing, people like Robert Kiyosaki and Grant Cardone and all of these different influencers out there in the investing world. And I keep seeing that they're doing all these, multifamily real estate and apartments and foreign exchange and stocks and Bitcoin and this and that. And he's like, I'm getting frustrated because I'm growing my business. I'm putting money aside and I'm afraid to lose it. I don't want to put it into something that, isn't going to work out, that isn't going to pay me. Because again, purpose of investing is to get a return back. So if it doesn't get a return back, it's not fulfilling its purpose. So how do we get out of that? Now, the first thing that we've got to realize in looking at influencers, we have to realize they started back here, right? We're seeing them here. Right? This is their current position. And so if we take someone that's a billionaire, right? Let's say an Elon Musk or a Jeff Bezos or even a Grant Cardone, billions of dollars in real estate, we're catching them in their current position. We don't know that Grant was a multimillionaire when he was my age. Right? We don't know that story. We don't know that he's 70 years old and he's been hustling for 40 years. And we're seeing 40 years worth of results. The $1 billion real estate deals on the jets. We don't see that Jeff Bezos back in the day was actually a Wall Street trader at a commodities firm. Amazon is a commodities company when you boil it down. We don't see that. We don't see that he spent 30, 40 years building up to become the richest man in the world, right? We just see he's going to the moon. And so what I want to point out is if we're just starting, We need to be looking at other people that are successfully just starting, or those that have already started and they're maybe in this current position and they're willing to tell us what they did 40 years ago. Because what they're doing today can't help us. Okay, so if I'm watching this, I'm like, I put a survey on my Instagram. What's king? Is it cash flow, passive income, compounding annual growth rate, or average annual rate of return? Do you know how many people said cash flow blindly just because they saw too many Facebook ads? Ridiculous. It's like cash flow is a surplus of income over expense. Literally, a 10th grader with a budget can say they have cash flow. This is what cash flow means. Okay, surplus of income over expense. It doesn't mean it's passive. It doesn't mean it's from an investment. It just means that I earned more than I spent. Okay, this is not like, sure, it's good. You should have that. Like when you invest, you should earn more than it costs. But that's like a very basic thing. If I think cash flow is king and I base all my investing on cash flow is king and put it in real estate, like it's gonna miss the mark. Right now, if I'm not yet financially independent, then passive income is king. This is the main thing I should be focused on, is passive income. Okay, passive income means that I don't trade the time for money. I get the income in no matter what, happens on a recurring regular basis. And I try and get to that equation of PI greater than set. Right now, when I'm sophisticated, I'm accredited, I start getting closer to this number of PI greater than set. When I get there, it changes to compounding annual growth rate. Now that becomes king because I already have the passive income. I've already become financially independent. Now it's about what is my compounding annual growth rate on my assets because I'm already free. Okay, now it's about how do I get to a $5 million net worth and a $10 million net worth and then grow it even from there. And then compounding annual growth rate becomes king. Okay, that's why you see Mark Zuckerberg and Jeff Bezos and these guys that have multiplied their net worths. They didn't do it with cash flow. They didn't even do it with passive income. They did it with compounding annual growth rates. Okay, so all of this stuff has to be thought about. It has to be understood. And it goes back to this very basic, do I understand it? Okay, what's my financial literacy level? If Jerry invited me to that family office oil and gas meeting, would I be able to go into that room and actually get something meaningful from it? Or would I be like, man, I don't understand anything they just told me? Okay, is that even happening on the stream right now? Am I on Facebook and YouTube watching this and I'm having bombs and diamonds dropped and I'm like, man, I don't understand a word this guy is saying. Right? Or do I think I understand it all, but I'm not applying it and I keep reinforcing my own knowledge even though I lack results? So much to think about there. Now, this is the first filter, right? So this is the first thing we look at. When I invest, this is the first thing. Do I like the deal? Okay, do I like the deal? I don't like things that I can't predict. Number one rule of investing, never lose money. Number two for me is always make money. So if it's not something that I'm always going to lose, always going to make money and never lose, I don't like it. So I don't speculate. I don't put money in crypto tokens. I don't do stocks or anything like that right now. I don't even do real estate like traditionally because I don't want to be a landlord. Okay, if you're caught on the real estate bug, the way to solve that, go join a landlords group and just sit there and watch the posts come in. Shit all over the walls. How do I clean it up? Got to call the cops on my tenants. What do I do? Can I evict these people or not? They're squatting. I don't know my rights. That's not investing for me, right? For me, investing is passive income right now. Okay. Because again, I'm going for PI greater than set. I'll be here in about 6 months, but right now I'm not. So everything I do has to do with, all right, is this growing my passive income? So that's the thing I look at is, do I like it? Well, I like it right now to the degree that it produces passive income. Do I understand it? Now, for me, I have a very great understanding of investing. I've been doing this for a decade of my life, since I was 18 years old. And so when I look at, do I understand it? I have a lot more depth maybe than the average person does on understanding something. Right. And so this is going to be based subjectively on me. If I'm brand new, and we're going to talk about this in a second, there's not a whole lot that I maybe understand. And so I have to really reduce my investing level down to my own understanding. It's like bowling with the bumpers on it. There's nothing to be ashamed of with it. I have to look at, okay, what's my understanding level? Sure, there's foreign currency, but I don't understand that. I shouldn't get involved yet. Doesn't mean I'll never do it. It means I need to spend the time and money to understand foreign currency as an investment and become qualified and understand it. Then I might get involved, right? Same thing with life settlements. If I don't understand life settlements, even though they're great, it's probably not something I need to get involved in right now. Okay, so I look at that. Do I understand it? Does it fit me as an investor? I am a very, very picky investor. I don't like volatility. Okay. I don't like losses. I don't like ups and downs. I don't like the idea that the ignorant masses can change the valuation on my investment based on their transactional history. Okay, I'm going to repeat that. I don't like the idea that the ignorant masses can manipulate my investment value through their transactional history. Just because a bunch of idiots decided to buy something doesn't mean it's worth more. Right. So I don't buy into things where the markets can swing up and down based on what the masses saw on CNBC or based on Elon Musk's Twitter feed. Okay. So it has to fit me, and then it has to fit my goals and purposes, which again, for me right now is PI greater than set. That's my only goal, my only purpose. Every deal I do has to fit that. Okay. So that's the first set of filters that I look at, right? So when do I invest? I invest on phase 3 of the blueprint. Right? Phase 0, I'm getting out of debt. I'm building financial literacy. Phase 1, I'm building solvency. Phase 2, I'm getting out of the financial traps. Right? And then phase 3, I now have like a degree of freedom of my capital, and I can start putting money into these deals. And so phase 3 is when I would begin investing. So this is the answer to when. Beginning in phase 3. And when I can answer these 4 questions, right? When I can answer these about the investment. That's going to be situational. Some of you guys might get to phase 3 and you immediately know, okay, I know what I like. I know what I understand. I know what fits me. I know what fits my goals and purposes. Boom, let's get into a deal, right? Some of us, we might be like, hey, I have kids and a family, and although I'm at phase 3, I haven't put the time in yet to learn about investing. So that's okay. I'm going to stick it out in my gold, my life insurance, and my HELOC for a little bit until I understand these 4 questions for myself, and I can jump into a deal. Okay, so that's the first thing. We're going to call this clothing capital, right? I have to be able to clothe my capital. Now, once I have that down, I need to look at, all right, where do I invest? This is the next question we've got to answer. Now, this is a new quadrant that I developed that basically breaks this down for you, right? And I'm going to pull the screen in a little bit closer. I think that's as close as it'll go, actually. This breaks this down for you. So when I think about, all right, where do I invest? We have investors' track record, right? The track record of the investor themselves. And then we also have the track record of the investments. Okay, so we have the actual track record of the investment itself. Right up here, we have unproven, we have proven. Here we have unproven, we have proven. And so what I look at on this is if the investor is in quadrant 1, it means that they are unproven as an investor with a track record. And also the investments that they're looking at are also unproven. Okay, this is what I call uneducated speculation. On here, you're going to see never do this for any reason. Never be a person that on an uneducated basis speculates. Okay? Let me break this down into my Alaska boy talk. Uneducated means I'm stupid. It means I am dumb on the topic. I don't understand it. It goes over my head. I have no intelligence about it. Speculation means I gamble, right? So it means I'm an idiot and I'm gambling. Now, I want to point out, because this doesn't mean that I'm bad at making Facebook videos, right? This doesn't mean that I'm bad at writing copy on posts. This doesn't mean that I'm not convincing online. So many of the people that I see giving investment advice on social media actually dwell in category 1. They're not going to come right out and say it, but they've never done a deal before. They're telling you to buy Bitcoin and Ethereum and this stock and that stock and this crypto. They have never successfully invested. So it puts them in the unproven quadrant as an investor. Now, the investments that they're telling you to do are also unproven. Cryptocurrency has no track record. It's unproven compared to what else is out there. We don't know what it's going to do. And so that means that it's uneducated speculation. You never want to be in that quadrant. The second quadrant, it means that the investor is unproven, but the investment is proven, right? So if the investor is unproven, then it's even more important that the investment is, right? So if I'm brand new, where do I invest? I invest in things that have long track records. I invest in things that have been around for a long time, that have paid for a long time, that are established, that I can look at history and say, okay, through not just the track record of this investment, but through different economic periods, because you can take any 5 or 10 year period or any compounding annual growth rate since inception and say, hey, this has been positive. Great, but what did it do during 2020? What did it do during the mortgage crisis? What did it do during the tech bubble? Was it even around during the tech bubble? What did it do back in the 1970s and 80s? What did it do in the 50s? What did it do in the 20s and 30s? If I can't look back and see those things, then it's very hard for me to say with certainty that this investment is proven. Okay, so when I was brand new at investing, where did I put my money first? One of my first ones that I did was gold and silver. Okay, because that's been around for thousands of years. Sure, it doesn't produce an income. I wasn't looking for that yet. My purpose was just to buy an asset and successfully hang on to it and make money. Okay, because I came from a world of paper assets and digital assets, stocks, bonds, mutual funds. I couldn't hold on to any of that stuff. Sure, it was conceptual, and I could look at a statement that said, Jerry, you made money, but I couldn't pick up my stock and be like, okay, I understand what this thing is. And I know what I can do with it, and I see the degree of control that I have. I couldn't do that. And so I was very interested initially in, I just want to get an investment that's mine and I can hold it and have it, and I can actually keep it and actually build some discipline and just holding an asset for a while. Okay, so I did gold and silver. Second thing that I got involved in was life insurance. Okay, life insurance, again, it's been around for over 150 years. It's always made money. It's never lost money. And so I can look back at everything all the way back to the Civil War and see that it made it through okay, and I can see what it did. So that was another one where, again, this one did produce some dividends and income. I could actually hold the contract. I understood it. It was part of my industry. I had a good understanding of that as well. Now, once I got through that, I then got into private lending. Okay, I understood loans. And this is what I love about private lending is all of us have borrowed money before. We've all been on the other end of that transaction where you have a credit card or a car loan or a mortgage or whatever it might be. And so we all understand debt. We've all had our experiences with debt, on the consumer side. So just flip it. I'm going to lend money out. I'm going to secure it with an asset. I'm going to get paid interest every month. Okay, I liked that. That made sense. And so that was something where I was able to find a fund that had a 40-year private lending track record. And I could look back and say, okay, great. Since, the 1980s or so, this investment fund has been paying out positive returns. And I can actually see that. And I can see they've never missed a payment. And so I know that that's proven, because I am not. At that point in time, I was not proven as an investor. Even though I had all the licenses and education, I had never done a deal before. So it's very important to me to think, okay, if I'm going to invest, the number one purpose of investing is make a return. I better sure as hell get a return out of this. And I'm not going to go gamble or speculate with it. So that's quadrant 2, right? So if I'm a new investor, then it's very important that the investment that I'm making is very proven. Now, quadrant 3 is kind of the sweet spot. This says educated value investing. This is the investor is proven and the investment is proven. This is where I'm at now. Okay, so when I build that layer of, becoming sophisticated, I'm still only going to invest in proven deals, right? But the spread of what I can start to invest in opens up, because back to this point here, my understanding is opened up. Because my understanding is opened up, I can like more things. I can be like, man, I'm interested in Forex. I'm interested in life settlements. I'm interested in trade line leasing. I'm interested in all sorts of different things that prior maybe never would have been on my radar, like we talked about before, right? It's kind of like when I was a kid, I used to hate olives, hated them, wouldn't eat them. Now I love them. Taste buds change. As an investor, the same thing happens. You grow in understanding, your maturity level changes, and you're like, okay, now all of these things that maybe I knew nothing about, or maybe even didn't like, now they're on the table. I can look at them again. I can maybe get involved in some of these other areas, right? So this should expand on quadrant 3. Now, quadrant 4 is the final quadrant. Okay, quadrant 4 is after someone is financially independent. So this is educated speculation, right? This is done after someone becomes PI greater than set, meaning they're financially independent. Now they can speculate a little bit, right? I talk about going from rivers to oceans. That's a law of nature. Rivers flow into oceans. It's not the other way around, right? So we get educated. We've already gone through phase 3. We've already achieved financial independence. Yeah, now we can do what Elon Musk is doing. Now we can do what Jack Dorsey is doing. Now we can do what Mark Cuban is doing, right? But to look at Elon and Mark Cuban and Jeff Bezos and be like, man, I'm going to do what they do because they're billionaires, doesn't make sense at all. You're not a billionaire. You shouldn't be trying to do what billionaires do if you're not even at $250,000 net worth. Right? If when you're a billionaire, yeah, you can go look at what do other billionaires do. But it's kind of like me taking, like my grandpa's medicine. As a kid, I'm sick. I shouldn't take grandpa's medicine. His medicine is for different things, right? Grandpa, yeah, he has a lot of life experience. He's successful. Those pills don't go in my mouth. I have my own medicine. If I get sick, I take a cough drop, right? I don't take medicine to help with, kidney pain or whatever it is grandpa takes. Different phase of life, different solution, different problem altogether. Okay. So this is what happens in the investor quadrant. Now, this is handling really looking at, okay. So I'm in this investor quadrant. Where do I invest? When do I invest? The other thing that I want to go into is the actual flow of a deal. Okay. Now, part of this, and actually I'm going to step back a little bit again on where to invest. This is another quadrant you can look at. You should be looking at earnings. You should be looking at track record. Okay. You should be looking at, the actual type of asset, right? So you should be looking at, again, hard assets initially. And then this final one is you should actually be looking at your goals in relation to it, right? So this kind of goes back into the first one. So if you're looking at what should I invest in, like if I'm through phase 2, I'm on phase 3, I should be looking at earnings, passive income, right? This thing has to produce passive income. I should be looking at the track record. I want to make sure it's backed by some kind of hard asset. Okay. And the reason for that is worst case scenario, what's going to happen, right? If this deal goes south, do I lose everything or do I have some collateral? Do I have a downside protection? Borrow gold, doesn't matter what happens to the dollar. I have a brick of gold in my hands. Piece of real estate, but it doesn't matter what happens to the markets. I have land and property, right? So I want to look at hard assets. And then again, what are my goals as an investor? Okay, so these are a couple of the things that we're going to look at. Now, the final thing I want to cover tonight is the actual investment process, right? So this is our 5-step investment process. And this really goes from getting to phase 3 on the blueprint. So when I'm on phase 3, I become a qualified investor, right? So this is the prerequisite of accomplishing all prior steps and phases to phase 3. Meaning if I say, hey, I have 50 grand, if I'm not past and through phase 3, it doesn't matter, right? If you come to me and say, I have 50 grand, let's do a deal. And we haven't done your sacred account or we haven't done your estate plan or we haven't helped you build up your credit worthiness, we're not doing a deal, right? We're going back to the steps that have been skipped until we get through them so that we can get to phase 3. And if we never get through them, we never get through them. That's up to you, right? This is something proven. If we follow the roadmap, it will get us where we need to go, but we don't skip steps. We don't go through distractions. We don't go to landmarks and visit the tourist attractions, right? So we get through here. Starting early is a myth. You don't want to start early. You want to start at the right time. And so that's why we say start at phase 3. At phase 3, we have laid the foundation. Trust me on this. If you try and start early without a foundation, this bottom stuff you didn't handle is going to come rip your investment out from underneath you, right? So starting early is a myth. Starting correctly is the truth. The greatest risk to investing isn't the asset. It's usually the investor. And that's why we get to phase 3 first, because we have removed most of the risk by that point in time. Next is deal analysis. Okay. Now think about how many people actually do deal analysis. Deal analysis is not going to a Twitter feed. Deal analysis is not checking Facebook posts. Deal analysis is not turning on CNBC and listening to someone else explain their viewpoint and their opinion of what they understood based on their own intelligence level on what the economy and the markets are doing. Deal analysis means I look at the asset quadrant, I look at the investor quadrant, and I look at the closed capital guidelines. And I ask myself those questions. And if it doesn't meet all of those criteria, the deal is not something that I'm going to do, right? I look at them. I don't have someone else look at them for me. I don't take someone else's opinion on it. This is why I don't believe in investment advisors. Advice means opinion. If I want an opinion about investments, I'll go to Thanksgiving dinner and I'll ask my brother-in-law what he thinks about investments, right? I should be investing based on what's true for me. If I can't look at the deal myself and analyze it, how am I to know what's really true? How am I to know if it actually fits these different categories in these different areas? And so this deal analysis, I need to run the investments through this process. There's 12 different points here, right? Each of these quadrants has 4 points, and then closed capital is 4 questions. So there's at least 12 points I should be running through at a minimum on the investment itself, just when I'm looking at it at surface level. Okay. Now, once we get through this, we decide on the amount, right? We decide on the amount. How much will I invest? Now, the minimum on most deals is going to be $50,000. Okay. And I don't try and invest sooner than this. I've done again, start early, start with a little bit, put in a few grand, put in a few hundred. No, just get to 50. The reason why is the investment decision you make with 50,000 is way better than the investment decision you make with 5. Okay, I posted this last week, but basically it comes down to, if you look at the speculation that's happening in the financial markets right now with cryptos and stocks, it's the people doing the speculating are billionaires and broke people. Okay, very few elites, the billionaires doing it. The reason they're speculating is because they have nothing to lose, right? They can't go broke. It doesn't exist in their world. They would have to literally lose money every single day for the rest of their lives, and they still probably wouldn't go broke. Now, the broke people that are speculating, they also have nothing to lose because they don't have anything in the first place, right? The guy that, I just put money in my crypto wallet and he's got $3,000 in there, like he can go save up for 6 more months and get the $3,000 back. So if he loses it all, there's nothing really there for him to lose. If he gains 9,000, that's a big deal in his universe, right? So I have to look at, okay, what am I going to invest? 50,000 is the minimum. Now, this is important. We get to 50. We make sure that we look at having the capital available, right? We don't shop for investments until we actually have money to spend. The next thing is we don't violate our 6-month reserves. We don't deplete our reserves on phase 1 in order to fund investing on phase 3. So the 50,000, that's above and beyond having 6 months of reserves in my sacred account. Okay. Now, the next thing we look at is determining where the capital will come from. This is where being an intelligent investor is so important. If I just take 50,000 cash, throw it in a deal, that's great. But I could have had the future value of that the future value of that 50,000 still growing. So if I tag the 50 first to life insurance or gold or my replace your mortgage, my HELOC, those are actually going to keep growing my 50 while I use it to invest. And I'm going to use the arbitrage strategy to double my returns, right? Where is the capital coming from? That's an important thing. And it's not just cash. Okay. Like you take a guy that just invests with cash and you stack him up against a client of mine that invests using the sacred account method. The guy using the sacred account at the end of the story has about 30% more money. I can show you that time and time again because he's getting growth on the life insurance or the gold or the real estate while he does the private lending deal, and it's simultaneous for him, right? So that's important. And then finally, what are the arbitrage spreads going to be? How will the deal pay itself back? This is really where thinking like the bank comes into play. Okay, the reason why I've been able to accelerate my wealth personally so fast is I invest like a bank does. Okay, I don't invest like the realtors do. I don't invest like the guys at the real estate investing conferences do. I don't invest like the Rich Dad Poor Dad's book tell me. I look at in 2020, when everyone else suffered, JP Morgan had one of their most profitable years ever. Their Q4 was the most profitable fourth quarter in company history. I want to know why that is. I want to know what they're doing, and I want to employ that with my own finances. And it doesn't matter what the fourplex guy says. It doesn't matter what the Bitcoin guy says. JP Morgan's not doing fourplexes in Bitcoin. They might sell you stuff so you can do them, right? But if you look at their portfolio, that's not where they invest their money. Now, once I've done my investment amount decision, then we get to something called a letter of intent. With a real investment, a private placement, it starts with a letter of intent. I know the deal. I understand it. I like it. I answered all the questions. I know how much I'm going to put in. I know where it's going to come from. Now I sign a letter of intent. At this stage, we're reserving our spot. We're saying, hey, I've got 50,000. I'm sending this to the fund. I want you guys to hold my spot because I intend to invest, right? This now opens up the door to due diligence, getting the private placement memorandums, looking at the financial statements, because they know I'm not just a tire kicker. In the private placement world and in the investing world in general, one of the biggest mistakes investors make, they treat investments like a commodity, right? Like, oh yeah, just send it over to me. I'll take a look. And they're not committed to any investment. They're tire kicking. Okay. Investment funds hate that. And an investment's not a commodity. An investment that's actually valuable, does what it's supposed to do, and pays on time is very rare, right? So when we show you one, you send a letter of intent first to show them you're not just tire kicking. You're not looking at 6 other PPMs, and you're not really actually going to make a decision, and you're just leading everybody on, and you're just going to keep your money in your bank or your 401k or your mutual funds, right? We want to know, is this person qualified? Are they willing to invest? And this is why the prior steps are so important. If I analyze the deal and I don't like it, I shouldn't sign a letter of intent. If I look at the deal and I don't feel comfortable putting 50,000 into it, I shouldn't ask for a letter of intent. I don't need to see a PPM. I don't need to see a financial statement if I can't answer these basic questions. Okay. So we do the letter of intent. If approved, the spot gets reserved. At that point in time, we go into due diligence and closing. Okay. These are the final steps to actually funding the investment. So due diligence, we review something called a private placement memorandum. So you read through the document detailing the investment, the risks associated, the business model, everything that you need to know, right? We go through the financial statements. We look at the cash flow, the balance sheets. We look at their profit and loss. We do a due diligence call, typically with the funds, talking with one of their reps or partners. So you can ask all of your questions and make sure that, you know, in addition to what we looked at, you make sure you've asked everything you need to ask. And then if everything checks out on both ends, because they're also doing due diligence on you, then legal agreements are signed. We move forward, we fund our deal. Okay. That's the runway to investing, right? So it's very different than what we might see out there today. And this all gets skipped over. No one says, hey, when I did this giant real estate deal, I competed against 100 other people and I got rejected on 6 of them before I finally got one. Right? Understanding like not just the finish line, but the runway leading up to it, like I showed you tonight, is so important, because you have to understand that you're going to have to do that runway. If you don't know that this exists, then the investing never happens. This is the reason why I talked about my buddy that was frustrated. He didn't know any of this stuff yet. All he knows is he sees, you know, Robert Kiyosaki and Grant Cardone and Richard Branson and Elon Musk and all these wealthy guys parading around on social media. He sees the result and he sees them saying, you got to do this, you got to do that. But they don't tell him all of the technical steps that they had to follow to get there. Right? It's easy to see a guru and what they have. It's very, very different to actually see a blueprint or a pathway to get there. And so that's what I'm showing you tonight. So guys, what I want to do here is I'm going to open this up for questions. We did run a little bit long. So I'm going to open this up for questions so that we can go over some of these things together. And I'm actually going to change my mic over before I do that. So you guys, if you have questions, drop them in the comments here on Facebook, drop them in the comments on Zoom. I'm going to pull up my other microphone here just so that we don't get feedback, because I've been getting that as of late. Okay, so let's go ahead and see what we have for questions. Let me know if you guys can hear my audio. I'm on my other microphone here. So we have a couple of questions in the comments on Facebook. Let me go ahead and hit these here first. All right, Brad says, I like investing what is simple, easy to understand, and matches my goals. That's awesome. Todd says, hello, WDXers, Financial Freedom Friday. We're all more educated than we were yesterday. Thank you, Jerry, for the continuously sharing your knowledge every week. My pleasure. I think Todd liked my analogies tonight, it sounds like. Let's see what we have here on Zoom. All right, so let's see if we have any questions on Zoom here tonight. Good to see everyone, by the way. I always appreciate you guys taking time out of your Friday nights. All right, I don't see any questions on Zoom, actually. I'm going to give everyone a couple of seconds to see if there are any that they want to throw down in the comments. So guys, if you have, questions about anything we covered tonight, maybe you have had that same problem of, I don't know where to invest, I don't know when to invest, or maybe I've been investing, I don't feel like I'm making progress. I would love to see what your questions are. So I can definitely address those with you live if you throw them down in the chat. And as we're waiting for people to drop in any final questions, if you're watching this tonight and you have not gotten a copy of my book, Blueprint to Financial Freedom, okay, get this. This is going to be Blueprint to Financial Freedom, jerryfetta.com/B2F2. Or sorry, just B2F, jerryfetta.com/B2F, the letter B, the number 2, the letter F. And this goes into everything you're going to need to know from phase 0 through to financial freedom with building your finances up, achieving financial freedom, building wealth, and investing. So get a copy of this if you haven't already. This is going to walk you through everything. We do have a question here from Mark. Let me bring Mark on. All right, so we should be live here with Mark. Mark, can you hear me okay?
Yeah, Jerry, I can hear you loud and clear.
Awesome. How are you doing tonight?
I'm doing great. Awesome show, Jerry, as always. Really fulfilling. content-wise and knowledge-wise. I appreciate your time and effort. Quick question. You spoke about reserves. Where do you keep your reserves? Personally, I don't keep them all in one place. I'm not sure if that's the correct way or if there's only one correct place to keep them. I tend to spread mine out through my sacred account, hard cash, gold, and a little bit in a bank account. And is there a better way or a correct way?
Yeah, that's an excellent question. For the most part, it sounds like you're on track, Mark. So for me personally, I keep 1 month in cash, nothing more than that. So I have 1 month of personal expenses, 1 month of business expenses. Cash is debt. It has a lot of liability attached to it. I keep 6 months in life insurance cash value, and then I keep all the rest in gold and silver. And then I try to keep, a certain amount on hand. Like, I want to have my 6 months, but a lot of my gold and silver, I collateralize and I put that into my private lending deals. So I've got the money in reserves in gold and silver if I need it, but very quickly I want to turn that around and get it producing income so that I can earn that arbitrage. So I probably only keep, like, in reality, I probably only keep about 7 months worth of reserves at any given time, where I'm not going to reinvest that money anywhere else. It's just going to sit there. And again, 6 months of that is my life insurance, and then 1 month of that is cash. Great question from Mark. All right, let's see what other questions we have here. If there are any other ones before we wrap up here tonight. All right, it looks like that might be it. So guys, again, we are going to be back live, next Friday, same time as always. Again, if you have not gotten a copy of my book, grab that, Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F. And if you have questions throughout the week, feel free to reach out. If you're watching this on the replay, drop your questions in the comments on YouTube, Facebook, wherever else, and make sure that you're back again next week. Thank you guys all for tuning in. Make sure that you do like, share, and subscribe. Have a wonderful week, and I'll talk to you next time.